Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves Podcast.
Hello again, and welcome back to episode 12 of the Seaspray Making Waves podcast series. And today we bring you our Q3 investment review and outlook with this usual insightful analysis and hopefully in-depth discussion around markets and the global economy. But before getting into all of that, just a quick reminder that this podcast and the Seaspray Making Waves series is available now on Apple, Spotify and YouTube platforms or directly from our website. You can also subscribe for free to our dedicated YouTube channel, and we'd be delighted if you could continue to like and share all of our content from our LinkedIn pages. And don't forget our free weekly market review, which publishes for free from our website every Monday morning, along with our full suite of market updates and video insights. And as I mentioned before, if you're searching for us online, be sure to use the search term Seaspray Making Waves. That'll make it easier and faster for you to find us. So for today, the plan is to take a quick look back in the rearview mirror at the quarter just gone, and then look ahead to the rest of the year at some key events and significant macroeconomic data, which will be of keen interest to all investors. And joining me to make sense of it all today, I'm delighted to welcome back our regular Seaspray contributors, Paul McGowan, Managing Director of Seaspray Financial, and Danny O'Leary, Head of Seaspray Private.
Morning, Marty.
Great to see you again, guys.
Thanks,
good to see you. So, what a quarter that's been. It's been an eventful one, like the rest of the year, really. We've had a lot. We've had market shocks. We've had record equities, record highs for equities, peace summits, AI rallies, even Federal Reserve governors getting the sack. It's all been there, underpinned by this uncertainty emanating from the White House. But Danny, I think there are the markets and certain sectors are looking beyond that volatility and beyond that uncertainty, looking at fundamentals, underlying fundamentals. Earnings in particular have held up quite strongly for the period. So I think that is a likely feature of the past couple of months.
Absolutely. I think another year where there isn't a day goes by with news, good news or not so good news. But I think the last quarter has actually been building on quarter two, where we went back into the green, and it's actually been sustained. I think, Paul, right through Q3, we are looking at markets at the moment in double-digit green. So there, you have the S&P up 13%, you have our own ISAC up 15 or 16, and European markets likewise in double-digit. If you'd asked me that back in quarter one after Liberation Day, that would be the position I'd have been saying, no way. Yeah. So we've come a long way since quarter one, and the whole uncertainty that happened around tariffs, trade, and the whole Liberation Day impact in relation to that. There is still uncertainty, Marty, and that will continue. Yeah. But I think the markets have dealt with it in a very resilient way, and countries and the deals that have been done, you're looking at tariffs that were probably at around a 3% level, have now shot up to about 17%. So that has a major impact. But again, the market and the trade deals that have done, it's avoided a trade war. It's avoided the global trade going into a spin. And actually, the growth rates that we're seeing coming from the IMF, 3% for world, 1.5%, 2% for the US, and 1% plus for Europe. It's still positive in terms of growth going forward. So uncertainty, but that's going to be part of the ongoing, view. But just to put it in context, the US economy is the world's largest economy. Its value is about 30 trillion. The tariffs and the implementation of tariffs under the Trump administration this year, it'll probably bring in up to 200 billion. So in a context of a market that's worth 30 trillion, it's 0.5% of the total market. So I think we just got to put everything in context. It's been an upheaval, but I do believe that companies and countries have actually dealt with that very well over the last 6 months. And hence, as you quite rightly said, company earnings have underpinned the actual fundamentals as we've gone forward. So it's been good.
An important thing is that there is absolutely no sign of recession. The fear factor is always, are we going to go to recession? Growth is solid across the world. Corporate earnings, as Danny's just saying, the last quarter end, strong earnings growth. And the forecasts are for that to continue. So this will provide a kind of support into the markets going forward. And as Danny said, the tariff situation, what's interesting in America is you do have a kind of a black economy where there's a lot of people pay cash for things. And by paying cash, the IRS was not capturing the taxes. So if you change the word from tariff to VAT, as far as the Americans are concerned, they're getting a VAT rate put on goods. And this is a way of capturing a tax, getting it into the system. And but as Danny has rightly pointed out, it's a very small relative to the actual size of the US economy.
And I think the corporate earnings, the margins that companies they've been able to take the shock of that up to now anyway.
Yeah. We're
not saying that tariffs are not going to have an impact. They will. And I think back, Paul, to the Fed and the way the Fed have acted on interest rates. Interest rates have come down in September by 0.25. But Powell and the Fed team have been very, very cautious, and rightly so, because tariffs bring inflation, right? So he's been very cautious, and I think they have enough ammunition, as Paul rightly said. We don't see a recession, but they have enough ammunition in the interest rate box to say that they can, even if growth does fall back a little bit, which we anticipate that it will. Yep. It won't be recessionary, but it'll be enough in the interest rate armory that the Fed will have to actually make sure that the economy is still moving along through 26 and 27, I think.
Yes, yeah. And there's a lot of good things coming. America has made, in America, corporates and at a state level have made enormous commitment into investment. So infrastructure investment linked into starting from AI, which is the big thing, you mentioned in the kickoff. They're talking about over the next 2 to 3 years, 1.2 trillion is going to be invested in America in building data centers, in building the back end for the supply of what's required to drive AI. Now, that's an enormous spend. When you put it against, Germany took a decision that they were going to have to lift their budget and they're going to spend about 50 billion next year. So the switch in spend is now going to be in America. Right. And that is going to help drive on corporate earnings because that money goes into all the large cap companies and that supports the earnings. And the expectation is that at the end of this quarter, you could see 15% outperformance on earnings in the US, which then underpins the valuations in the markets over in the States.
I think, yes, our market's highly valued in the US. I think the answer is yes, but what we're suggesting is that the earnings which are underpinning those valuations are keeping pace, and it only takes the market to move sideways for a few months. And you can, if earnings are consistent, you'll get them back to levels which are not viewed as extremely overvalued. So there are companies that are in that space, but there are still a lot of companies, both in Europe and across the globe, that we feel there is still room for growth over the coming 2025, 26, well, out to year end, definitely.
If you mentioned Europe there, Danny, and just there is an additional factor. I think it's worth highlighting that's the weakening position of the US dollar. I mean, that surely must impact trade and investor decisions going forward. I mean, what's your view on that?
Well, yes, the dollar had a very bad start to the year. Like, it's gone from 103 to 117 against the euro. But Donald Trump wants that because part of the refinancing of their bond market, the weaker dollar makes it a bit cheaper for them. From here is the question as to where it's going to go. There are conflicting views. People talk about, the tariffs are going to upset the situation. We've already discussed that, so we don't see a further hit coming from that. the spend that's going to happen in America, this 1.2 trillion infrastructure in spend, that will probably in time start to reflect into the dollar, and you will start to see some confidence coming back into it. The recent, as we know, negotiations have been going on to bring an end to the war in Palestine and the Gaza situation. That's all going to turn out probably to reflect positively on the American situation. Now, there has been a big move in gold. Obviously, we've seen real highs there.
Sure.
But there are other reasons why gold is also held as an alternative. And it's it's interesting, you can pick up anecdotal evidence. One investor I was talking to recently highlighted to me that the redevelopment that's going to happen in the technology. So as AI comes through, there's going to be a build out of new computers and new supercomputers. And one of the things used actually within the building of computer parts is little pieces of gold. So gold is actually required sometimes as a conductor. So apart from central banks buying up gold and apart from investors seeing it as a safe haven against if the dollar was going to be weaker, there is actually a commercial reason for doing it as well. Yeah. It becomes a key commodity. Yeah, so it's very interesting markets, when you start seeing this and hearing this, and this provides support.
I think on the dollar, for emerging markets, the weak dollar is actually a help in terms of any debt and et cetera. The price of oil is in dollars.
Correct.
I don't mind a weak dollar, et cetera. So there are going to be pluses and there are going to be minuses, right? Yeah. But I think most companies, they will actually hedge and do different things to protect their business models from a currency perspective. So I think there are mechanisms in place to actually alleviate some of the pain, but also there's still a positive aspect to the fact that we're seeing where the dollar is at. We've seen it before. And the critical thing here is that I think companies will be still well positioned to actually deal with that as we go forward. But I do see it from the current levels probably coming with a bit of strength, possibly into 2026 in relation to that market.
Great. Yeah. Thanks, Danny. I'm just going to take the conversation just back home for a second. We've looked globally there, but we just had our own recent 2026 budget, described by many as the enterprise budget. And on the surface, it looks like it's good for business, stimulus for hospitality, infrastructural projects, tourism, all of which are important for the Irish economy. But Paul, do you see it as being a real positive for economic growth here and jobs particularly, I would imagine?
I think the big thing that everybody's talking about is housing. So there are a whole number of provisions that were announced in the budget that are going to be used to help drive further housing. Now, the full details will only be seen when the bill is published, but the minister did talk about incentives for over-the-shop reconversion of properties so that you can move into, turn them into apartments above shops. There's going to be incentives for development in certain regions in the cities. There's also, obviously, they're going to continue a form of tax on the land that isn't being used. So, and there's a range of other things being done. So if they can address the housing issue, and then there's a very ambitious program for the next 10 years of infrastructure spend across the country. So what they're bringing in, obviously, Metrolink has been announced, and they're going to commence on that. So if all of this can be done, then it will continue to stimulate the economy. Remember, we are in a country where we've full employment, effectively. So it'll actually be looking to bring in more workers into the country to help drive it. We have the highest number of people ever in the history of the state working. And so the tax receipts are very strong. Big fear always is, will the international companies downsize and, will we lose people? To date, we've had reconfirmation from every one of the major tech and pharmaceutical companies committing to their operations here. Yeah. Yes, there are issues about having to have stuff in the States, but almost all of the big people already have factories in America and can prove that, so they're not going to get hit with higher tariffs. So I think, on balance, you're going to see this system, the country continuing to grow. And I think it's to me, it came across as a very positive sounding budget.
Yeah.
Obviously, on a personal income tax level, there was no changes there.
Yeah.
And with inflation, that does mean that actually the benefits we're losing a bit. So, but income growth has been relatively strong. Salaries are up over the last 12 months for people. So there is an offsetting against inflation. All in all, the markets reacted positively to it, and people seem to be on balance looking forward to where things are.
Yeah. I think it's there's a bit trying to balance this, because there was a pressure that if you pump in too much, you're going to overheat an economy. And on the other side, you still have people hurting from the cost of living. There's no doubt about it. So you have the one-off giveaways that, in terms of the last couple of years, they've gone, and that will hurt people. Yes. There's no doubt about that, Marty. So I think there was a bit of damned if you do and damned if you don't to it.
Yeah.
So, but on the balance, in terms of where do you want to see the economy over the next while, you do want to have employment, you do want to have companies, delivering. So I think in terms of, for me, the major one is that over the next number of years, the amount of money being spent on infrastructure. If we're going to have housing, you've got to have water, you've got to have sewage systems, you've got to have all the backup, you've got to have electricity. That's going to be key in terms of making sure that we can deliver on any housing and any further, growth in terms of where we're coming from.
To that, there was absolutely a strong commitment to infrastructure. I've just got to bring the conversation in-house just for a moment here. We're continuing to bang the ESG drum, Danny, with our investment themes around our own in-house structured product solutions. And I think, the trend is towards, and will continue towards, sustainability, artificial intelligence, clean energy, renewables in particular. That's likely to continue, right?
Well, I might just as a plug, our research analyst, Carl Slevin, has done some super work. And if anybody can have a look at some of the insights, certainly on the renewables, some great work done there. But you're absolutely right, Marty. The focus, fossil fuels are in that downward trajectory now. The major move from the globe, and even taking the US and what we've seen from the administration, the move to renewables is absolutely, it's at a pace, and we believe that will have impact over the next decade. So from our view in terms of growth, you're going to see the fact that renewables and the focus on green and carbon reduction is going to be key on the agenda going forward. Carbon and fossil fuels, they have a lifespan, but it's on the decline. And that is a worldwide phenomenon. So yes, and if you take AI, which we believe is a strong growth theme. So alongside ESG, we believe, as Paul alluded to, the AI and the growth AI is bigger than the internet. It's bigger than when we had the railroads. It's bigger than when China joined the World Trade Organization. So the amount of money, if that's over $1 trillion, then you're going to see growth in that area. But AI will transcend every industry across the planet. Yeah. So we firmly believe that in terms of that as a growth theme, alongside renewables, alongside ESG and the climate, are very key focuses for us.
And to give a perfect example, like in America, in the coming 12 months, they're going to spend on data centers, which is the backbone to AI, is going to exceed the total real estate commercial spend in America.
There you are.
You're going to have more done on data centers. Yep. And we're having the same in Ireland. But the data centers now, what a lot of them are doing is they're building, wind farms and they're using solar to drive, because the demand for energy is so enormous from data centers. Yeah. So this is all a continuation, feeds into the themes, the in-house themes that we have been investing in.
Yeah, absolutely. And I refer our listeners to Carol's done an excellent piece on the levels of foreign direct investment, and renewables are pretty significant in that particular stat. So,
www.seasprayprivate.ie.
There you have it. There you have it. Shameless. Right. So I've got sorry, Danny, you want to say
just one thing? Yeah. We always focus on the 4 I's.
Yeah.
Inflation, interest rates, investment and growth. So I think interest rates are in that cycle where they've come down, and we're seeing that in Europe. They still have a pace to go in the US, which is the ammunition they need to avoid recessions, etc., and growth. I think inflation is subdued, hasn't gone away and won't go away, but it's at levels where I think they're in a reasonable sort of area of 2 to 3% in relation to that. We've highlighted earnings, which I think are reasonably strong as we go forward. And on the investment themes, I think we've highlighted a number of areas that we still believe are very strong going forward into 26, 27.
Yeah, okay, great stuff. So I do have a couple of questions from our clients and our podcast viewers. So I'll start off, Paul. I have one for yourself, which is on the markets. So the question is, through everything this year, the VIX, which is the volatility index, has remained low by and large. Is that a good gauge of market confidence in the long term? And are there specific stocks that reflect that?
Yeah, and the VIX is called the fear index. And it's a perfect thing to look at because people will trade it first. If they see things happening or anticipate that things are going to happen, they'll use it as a hedge against what they fear is going to happen in the markets. So the VIX at the moment is trading around 16. Put it in context, when we had global crashes and such like, it was trading up in the 80s.
Liberation Day was up at 50 odd.
Correct. It shot up and then came right back down again. Yeah. So when you see it around these areas, it's telling you there isn't a whole lot of fear in the markets. And so that then goes to, you go back to the normal way that you then analyze companies. And corporate earnings have been so strong that yes, share prices have moved ahead, but the corporate earnings have moved up at the same time. So one of the multiples that people use to look at is the price earnings ratio. So on a lot of situations, when you take the earnings growth in, the share prices of stocks are actually only looking fair priced. Now, we can give some examples. If you look in the States, Colgate, big international company, its share price has driven on. It's trading around 78. Currently, that's only 20 times earnings. Historically, it used to trade at 25 times. So markets have a target price of about 110 on it. If you look at some that we've recommended over the years, so CRH, Microsoft, Ryanair, if we go back 2 years ago, CRH was trading around $52 equivalent. It's trading 118 today. Yet most people have targets of around 140 for that because of the earnings growth coming through so strong. And obviously they're doing organic acquisitions all the time. Microsoft 2 years ago, trading around 240. Today it's 524. And the average forecast is that Microsoft's going to get to 680 over the next 12 months. Ryanair trading at 14 2 years ago, trading at 25.3 today with targets of up to 30. So what does this say? As we've regularly talked about, and again, one of the data insights done by Carl Slevin talks about time in the market, not timing the market. Despite all the ups and downs that have happened, the forecast that we put in this time 2 years ago, our those share prices have all more than doubled. Yeah, that's up over 100%, despite market moves.
Perfect illustration. Absolutely perfect illustration, and answers that viewer's question very well. Thanks, Paul.
But that's not to say we are not going to get corrections going forward. So again, it's about time in the market. So I keep saying, next week we could have another market correction of 10%. It will happen. This is what markets do. Yeah. And it's having that patience. I keep saying it's about transferring money from the impatient to the patient. Yeah. So it's all about being in the markets.
Yeah, absolutely. I'm going to give you a quick opportunity for another shameless plug here, Danny. So this question is from an investor. What are my options if I'd like to green up my pension fund with some more sustainable investments offering a decent return?
I think my answer is that it's not about greening up. It's got to be right for your portfolio. It's got to be right for the overall diversification within your portfolio. And if that involves ESG, products within that portfolio, absolutely, it's right for you in relation to that. And yes, they're very much part of the themes that we would be looking for going forward.
Right.
Yes.
Cool. That's great. And again, there are a number of insights and videos from Cathal that cover time and patience in the market. Totally. Yeah. There's one on the VIX as well, which is worth checking out in recent weeks. So I'd encourage viewers to do that. Guys, unfortunately, the clock has caught up with us again. It just flies. As always, terrific insight from you both. Your contributions are very valuable. I'm sure our viewers will take a lot from today's discussion. So thanks very much. And we'll see you at the next podcast. Okay. So to read more detail on today's discussion, you can now download for free our Q3 investment review and outlook directly from the website. And you can also like and share the content from our LinkedIn pages. Just a final reminder that this podcast and the Seaspray Making Waves series is available now on Spotify, Apple, and YouTube platforms. And you can subscribe directly to our dedicated YouTube channel. And don't forget, if you're searching for us online, use the search term Seaspray Making Waves. So that's it for today. Many thanks as always for tuning in, and we'll catch you next time. Bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. Thank you.